Morning and welcome to Qnews Economic Bulletin. We bring you the latest top economic stories along with expert analysis on the events and trends shaping the regional and global economy. Throughout our coverage, we spotlight key sectors and highlight the defining economic developments of the moment. To start with the latest headlines, we hand over to our colleague Mark Summers for the top economic stories. What do you have for us today?
Well, thank you very much, Bonnie. Yes, we've got a load of economic news and developments from around the world. And we start off with global projections as the World Bank has lowered its global growth forecast for 2026 to 2.5%, citing risks from the Middle East conflict and potential energy supply disruptions. It warned that growth could slow to just 1.3% if the crisis triggers significant financial market stress. In its latest Global Economic Prospects report, the World Bank estimated global growth at 2.9% in 2025, 0.2% points higher than its January forecast. However, its 2026 outlook was revised down 0.1%, and marking the weakest growth rate since the COVID-19 pandemic. If disruptions persist and oil prices rise to an average of $115 per barrel, global growth could slow to 2.1%, while inflation climbs to 4.4%. A more severe scenario involving financial market turmoil could reduce growth to 1.3%, accompanied by heightened volatility and weakened investor confidence. And to Europe, the European Central Bank has raised its key interest rate from 2 to 2.25%, marking its first rate hike since 2023, as inflation accelerated amid rising energy prices linked to the conflict in Iran. This marks the ECB's first rate hike since September 2023. The ECB President, Christine Lagarde, said the outlook for inflation and economic growth remains uncertain while the conflict continues to drive energy costs higher. The central bank also increased the rate on its main refinancing operations to 2.4% from 2.15%. France's statistics office, INSEE, has reported that consumer prices rose 2.8% year-on-year in May, the highest level since February 2024. On a monthly basis, the core price index edged up 0.1% after a 1% rise in April. The increase was driven mainly by higher energy prices at 0.6% up, led by a sharp rise in gas, partly offset by lower petroleum product prices. Food prices also rose slightly, while manufactured goods increased marginally and services and tobacco were stable. On a seasonally adjusted basis, prices rose 0.3% in May after 0.7% in April. Core inflation climbed to 1.5% year-on-year from 1.2%, while EU harmonised inflation rose 2.8%, up 2.5% in April. And now to Britain, where the Office for National Statistics has reported that the UK economy contracted 0.1% in April, marking its first monthly decline since August. The drop was partly attributed to disruptions in the entertainment sector, including cancellations of Formula One and other golf sporting events linked to the Iran war. Services output fell 0.2%, driven by declines in administration, support services, arts, recreation and entertainment. Manufacturing rose 0.4%, supported by a rebound in pharmaceutical production, which is typically volatile and helped offset weaknesses in services. Overall, GDP in the 3 months to April was 0.7% higher than in previous 3-month periods. And to the Middle East and North Africa, and the Central Bank of Turkey has kept its policy rate unchanged at 37% for a third consecutive meeting, while maintaining a cautious stance on upside inflation risks. It also left the overnight lending and borrowing rates steady at 40% and 35.5% respectively. The bank said inflation's underlying trend eased slightly in May after rising earlier in the year due in part to higher energy costs. It added that geopolitical tensions continue to keep energy prices volatile and elevated. Future policy decisions will depend on realized and expected inflation and its trend to ensure a tight stance consistent with the disinflation path and interim targets. And in North America, the U.S. Treasury has refunded nearly $22 billion in tariff revenue to importers in May, effectively offsetting customs duties collected during the month, adding that around $166 billion is tied to the dispute. The repayments mark the first major wave of refunds after the Supreme Court struck down part of President Trump's tariff policy, ruling that he lacked authority to impose tariffs under the International Emergency Economic Powers Act. Treasury Secretary Scott Bessent said that the refunds would be returned to companies that paid the duties on imported goods. The U.S. Labor Department reported a slight rise in jobless claims last week, suggesting continued resilience in the labor market in early June. Initial claims for state unemployment benefits increased by 4,000 to a seasonally adjusted 229,000 for the week ending June the 6th. Meanwhile, continuing claims, often viewed as a proxy for hiring, rose by 24,000 to 1.795 million for the week ending May 30th. Now, right down at the bottom of the southern hemisphere in Oceania, the Bank of New Zealand has reported that manufacturing activity contracted slightly in May, slipping back into negative territory after 7 months of expansion, as businesses remained concerned about weak demand and global economic pressures. The bank's business seasonally adjusted performance of manufacturing index fell to 49.9 in May from 50.4 in April and 52.8 in March. A reading above 50 indicates manufacturing activity is expanding, while anything below that threshold points to contraction. And to commodities, oil prices fell more than 2% on Friday, extending losses from the previous session after President Trump cancelled plans to strike Iran last night, reducing fears of an escalation of hostilities following tit-for-tat attacks earlier in the week. Brent futures were down 2.3% at $88.27 a barrel, while U.S. West Texas Intermediate dropped 2.2% to $85.81. And gold prices have fallen today and we're on track for a weekly loss, pressured by concerns around inflation and potential U.S. Federal Reserve interest rate hikes. Spot gold was down 0.8% to $4,182.47 per ounce and was set for a weekly loss of 3.4%. Meanwhile, U.S. gold futures for August delivery rose 2.2% to $4,203.60. Gold fell to more than a 6-month low on Thursday before closing higher at $4,219.69 as President Trump called off the planned military strikes on Iran and signaled an imminent peace deal. Now, those are the main economic headlines, but let's go back to Mona in our studio for more. Mona.
Thank you so much, Mark. And we now turn to a more in-depth analysis as governments are increasing borrowing to finance defense infrastructure, clean energy projects, and the rising costs of aging population despite higher interest rates. Let's take a closer look. Bloomberg has reported that governments worldwide are increasing borrowing to finance defense, infrastructure, clean energy projects, and the rising costs of aging population despite higher interest rates. Global sovereignty bonds syndication issuance hit a record $504 billion in the first half of 2026, surpassing the previous peak reached during the COVID-19 pandemic in 2020. Italy, the largest borrower in this market for 8 of the past 10 years, has already raised nearly $81 billion this year. The growing reliance on debt reflects mounting fiscal pressures, including military spending, energy transition, investments, and support measures to offset inflation driven by geopolitical tensions. For more analysis and details on this topic, we are joined from Beirut by financial market analyst Daniel Al-Banna. Good morning to you, sir, and welcome to Qnews. And let me start by asking, how is the record pace of sovereign bond issuance affecting global yield curves and bond market liquidity?
Good morning to you and to everyone. Thank you for having me here today. So, of course, due to the issuance of the debt, first of all, we need to know that the global debt is increasing, especially in the US, in Japan, in Europe, due to many factors, and this war made it increased fast. So, what is really happening is they need to borrow money, so they are issuing those bonds. So, they are technically selling bonds, which means lower price and higher yields. It's a vice versa. And when the yield increase and the market is pricing that the inflation will be back, and there is a structural inflation due to the rise of oil prices, which will make the monetary policy tightened somehow, especially in the US and in Europe, which will increase the yields, and that's what is happening really. And the yields are increasing, so technically the borrowing cost is increasing, and the interest for those that's especially in the US is increasing. So in that case, this is a very important we should consider. But the market technically is just ignoring every fundamentals. They are ignoring the higher yields, tightening of monetary policy. They are ignoring the war, or let's say the overvaluation in stocks, and of course they are ignoring the inflation, that it's back. So the market is just moving based on a possibility of truce between the US and Iran, which is we should take it into consideration. And it's like for me it's a fear. We should we should focus on it, since it is since in the upcoming weeks, when this is ends the catalyst, and there will be another catalyst, which is what's happening now in the market. And that's why last week we had this sell-off in the market.
Right. Now, to what extent are rising sovereign yields reflecting fiscal concerns rather than monetary policy expectations?
Really, what's happening is there is a lot of concerns, especially in the fiscal policies, especially in Europe. What is really happening, and what we are really trying to do, is they need some fiscal policies to lower the exposure to the oil prices, and of course to defend themselves. As you know, started in Russia and Ukraine war, which made Europe do fiscal policies to pay for the military, especially in Germany. So they issued a lot of bonds to borrow money for the military sector to protect themselves. And now it continued due to the increase also in high oil prices, which make the governments focus on sustainable energy and green energy, lowering exposure to oil, which why there's a lot of concern related to the fiscal policies. As you know, the balance sheet of the countries still in negative due to many factors, especially in Europe, lower growth and what's happening. So technically, they need more money, and they will issue more bonds in order to enter more investments in green energy and in and sustainable energy, in order to lower the exposure of oil shock in the upcoming years, not just in Europe but also in other governments, other countries like in Asia also, especially now due to the Strait of Hormuz.
How are higher government's borrowing costs being transmitted to equity valuation and broader risk assets?
In my opinion, of course, higher borrowing, it is like lowering the profit margin of companies. The companies that are really suffering is the small cap companies and medium cap companies, since they borrow money, they take loans, they borrow money in order to fund their operations. And when the interest or the yield, let's say, increase, the cost of borrowing increase, their profit margin will start decreasing. And it's like a, there is a pyramid of small cap, medium, and large. So when the small cap starts suffering, the medium will be like cut. Yani the lag of the medium companies will be cut, since the small companies are suffering, and also the large cap. So it's like a domino effect. So they start with the lower market cap, and to the lower, and then to the medium and to the large. So what's really, in my opinion, will be is lower profit margin, lower earnings, which it might affect the market, as the market, it's really somehow like they are saying that the earnings will be amazing, especially in the technology sector, the overvaluation, and that's what's happening there. In my opinion, there's no more valuations, overvaluation, or undervaluation. It's just a hype market where every dip the retail traders enter and buy it. So that's why what is really concerning, and that's why we didn't see till now any effect due to the increase in higher yields, since till now the retail traders are still there, are pricing the truth, and they just are entering in every depth, which means they are not entering based on any valuation, overvaluation, undervaluation. The institutional traders are like sitting in other place waiting, while the retail traders are moving based on a hype, which it is concerning.
Is the surge in sovereign issuance crowding out private sector financing and tightening financial conditions?
Of course, it will affect especially the private sector, as you can see, for example, in the U.S. There's private companies or private businesses that they are suffering as due to more lending and lower buying purchase of consumers. So in this case, they are facing two problems, which is low sales or sales revenue, and in the same time higher borrowing costs. So they are being affected by the lower profit margin. So they are like now, and I know people in the US. I know they have businesses where they are just break even to continue. They want just the break even to continue in these businesses. So what's really happening? It's not showed on it's not reflected on the financial markets. But if we want to go deeper to those private companies, we see that they are suffering a lot, especially the small cap companies. So if the borrowing increase, and that's what's the plan of the head of the Federal Reserve, Kevin Walsh, his plan is to lower the balance sheet, which means to sell bonds in order to increase the yields. So in some way, it's an indirect way to increase interest rate to protect themselves. So he doesn't want to face Donald Trump, the president of US. He just wants to tighten the monetary policy in an indirect way, in order not to face President Trump. So in the upcoming weeks and in the upcoming months, we will start also to see more suffering, especially that the effect of war still not being reflected 100% on the economies.
Right. Despite elevated real yields, gold has rallied towards $4,000. Now, what does this divergence signal about investors' perceptions of fiscal and geopolitical risks?
What was really happening, if we can go back to January, starting of 2026, we can see that the price of gold surged in a very fast way. It reached $5,600. since the market was already pricing the war between the US and Iran. What really happened when the war started and the Strait of Hormuz was closed, the market started pricing increase in oil prices, which means increase in inflation, which means increase in the yields. So this affected the gold. In my opinion, the gold still there is a liquidity movement, and in my opinion liquidity moves. So when I am an investor and I am seeing in the AI sector and the US technology sector there is a returns that they are making 100%, 200%, 300% returns, of course it is due to the hype. But when I see it and gold is making me 30%, 40%, I just I leave gold, I dump the gold, and I go to those things, to those US companies. So the liquidity is changing. However, of course, gold it is very important to have it as to hedge against the inflation. But unfortunately, the retail traders are not seeing this, and they are dumping the gold, especially due to the increase in higher yields. But in my opinion, I remain positive on gold. But in the short term, we might see a more downtrend, especially if it broke the $4,000. You might see 3,800, 3,700. But it will be a buying opportunity for the long run, as I use the DCA, dollar cost averaging. I buy in an average way in order to let's say to make money when the price start increasing. So somehow I remain positive on it, especially when we are entering into a more economic difficult, which might lead to a some lowering interest rate due to lower GDP. This will increase the price of gold, especially if the banks like China and other banks continue to buy gold, which is it might reach another level. So I remain positive on it, but on the short term and medium term, due to the war and what's happening, it will remain under pressure.
Right. Could sustained debt issuance force investors to demand a higher term premium, pushing yields even higher?
Yes, what's really happening is, as you know, it's as a vice versa. So when you are increasing, when you are selling the bonds, more supply, it is a higher yields. Since it's a vice versa, price of bonds go down. So of course, we are back into, let's say, a difficult moment, as a difficult scenario, which is the US Treasury yields continue to increase. It reached a historical levels it didn't reach it before. So this is a really concerning thing. But it might also increase, especially if they increase the interest rate, or they did the indirect way, which is lowering the balance sheet of the Fed. In this case, the investors will see it more concerning about this, and they will start to exit. Especially what's happened last week, especially on Friday, the labor market came positive somehow. The market or the investors were pricing that they will not lower the interest rate, they might increase it from now till the end of the year. So we had this sell-off moment, and it continued till yesterday before the announcement of President Trump of a truce. So what's really concerning is we might continue to see downtrend movement on the US market if the market continues to price the fundamentals that are really happening in the market. And I'm somehow still negative on the US indices. However, the truth, that's the main problem. Due to the truth, the market increased again. It's being moved by just a hype. And I don't like to move to follow the trend and to follow the hype, which for me, I am very now conservative on it, and I am waiting for a more downward movement in order to start entering the DCA, as I talked about this in different other channels, that I don't buy the dip now, and that's what really happened. The market increased more, decreased more, I mean. So I rather to wait. I rather to start somehow DCA on a couple of stocks I am focusing on in order to buy them for the upcoming, let's say, long-term strategy years.
Right. What are the key market indicators real yields term premiums, inflation expectations, or credit default swap spreads that investors should monitor to assess sovereign debt risks?
In my opinion, it is everything now. It's everything is connected. Why? First of all, let's start by inflation. The core CPI, which excludes the food and energy prices, it's increasing, and it's hard if the core CPI increase, it's hard to start going down. So, in my opinion, of course, in my opinion, the market might pricing a structural inflation, which it is more fear to the market, since it is not just because of oil increasing, but even if the war ended, we need a lot of time to lower inflation. So we are focusing on the structural inflation and the possibility of structural inflation. In addition to that, of course, focusing on Kevin Warsh's first meeting on June 16 in the Fed meeting, they will focus on his plan, especially related. I am focusing, like as a Daniel, I am focusing on his let's say balance sheet of the Fed. If he wants to do it, it will also affect the yields. And of course, in addition to that, the movement of President Trump, of course, and its announcement related to the market and related to the uncertainty. So when you have a huge uncertainty, you just to take it into consideration. So all those factors are affecting the yields and will continue to affect the yields in the upcoming months until the photo is clear, let's say, and the path is clear, which is now it is very hard to do it, as due to the high uncertainty and the movement of President Trump. Yesterday, he just announced on Twitter or on X that that there is a possibility of truce. The market was going down, but suddenly in a 5-10 minutes, the market increased so fast. So it's hard to monitor for the long term. So it's more now it's a speculation instead of investment for the long run.
Yes. Well, from Beirut, that was financial market analyst Daniel El-Benna. We thank you so much for your deep insights. And all eyes turned to Mexico overnight as the FIFA World Cup 2026 officially kicked off, marking the biggest edition in the tournament's history and one of the largest global economic events ever staged. With 48 teams and 104 matches, the tournament is expected to generate tens of billions of dollars in economic activity across sports, media, tourism, and technology. From record revenues and rising investor interest to the growing role of AI and digital infrastructure, the World Cup has become far more than a football competition. It is a global economic platform. So, what does this edition reveal about the future of the sports economy and who stands to benefit the most? The FIFA World Cup 2026 has kicked off across the United States, Canada, and Mexico, marking the largest tournament in history with 48 teams and 104 matches. FIFA expects revenues of nearly $9 billion, while the event could generate more than $80 billion in global economic activity. Prize money has reached a record $871 million, with each participating team guaranteed at least $12.5 million. The tournament also sets a record for Arab participation, with 8 teams competing, including Egypt, Morocco, Algeria, and Saudi Arabia. The combined market value of teams competing in the FIFA World Cup 2026 has exceeded $19.6 billion. France is the most valuable squad at 1.52 billion euros, followed by England and Spain. Among Arab nations, Morocco leads with a market value of nearly 500 million euros, while Egypt ranks third among Arab teams. The 8 Arab teams participating in the tournament have a combined value of more than 1 billion euros. The FIFA World Cup 2026 is set to be the first tournament powered extensively by artificial intelligence. The Bank of America Global Research report revealed teams will use AI to analyze player performance and match data in real time, while all 16 stadiums will operate with digital twin technology to monitor crowd movement, security, and operations. Analysts estimate the event could generate up to 2 exabytes of data, making it one of the largest data-driven sporting events ever staged. The global sports industry is expected to grow into a $3.7 trillion market by 2030, underscoring its rising economic significance. According to a Bank of America report, the sector generated an estimated $2.3 trillion in revenue in 2025, supported by media rights, sponsorship deals, streaming services, sports betting, and private equity investments. The bank says the 2026 FIFA World Cup is likely to accelerate growth across the global sports economy. Meanwhile, Hong Kong authorities have seized counterfeit World Cup merchandise worth an estimated 156 million Hong Kong dollars, or nearly 20 million US dollars, in one of the largest recent anti-piracy operations linked to the tournament. Customs officials said around 230,000 suspected fake items were confiscated, including jerseys, footballs, and boots. The goods were reportedly intended for exports to the United States ahead of the 2026 FIFA World Cup. Authorities say the case highlights the growing global trade in counterfeit sports merchandise during major international events where demand surged sharply. Right, for further analysis, we're joined from Al Wajh, Saudi Arabia, by specialist in sports education, Dr. Joel Daw. Good morning to you and welcome to Qnews. And let me start by asking, the 2026 FIFA World Cup has officially kicked off. From an economic perspective, what makes this edition different from previous tournaments?
Hello, it's my pleasure to be with you. Talking about the World Cup this year, it has a very special situation with 48 teams, 104 matches, and 3 countries, the US, Mexico, and Canada. This game creates far more commercial inventory, ticket sales, sponsorship opportunities, broadcast content than any previous tournament. That's why it's so special.
Now, FIFA expects nearly $8.9 billion in revenue from the current World Cup cycle. What are the main drivers behind this record figure?
So basically, we can start with broadcasting, which comes in the first place. Then we go for sponsorship and marketing goals, and broadcasting for sure. And last but not least, ticketing and hospitality.
Right. The tournament has expanded to 48 teams. and 104 matches for the first time. Now, how much of the expected revenue growth can be attributed to this new format?
Well, it's a substantial portion. More teams and matches means more tickets, more hospitality packages, more broadcast hours, more sponsorship exposure. Then FIFA itself, in her studies, identified that tournament expansion as a major reason for record revenues.
Now, beyond FIFA's revenues, what economic benefits are expected for the United States of America, Canada, and Mexico, particularly across tourism, hospitality, transportation, and retail?
Well, the biggest gains should come from tourism, as you said, because we have a lot of visitors, more than billions, attending the World Cup. So we can focus on the hotels, on the transportation, retail spending, event-related employment. So I believe there will be a huge impact for the three cities, the three countries, sorry.
Now, the World Cup is increasingly becoming a technology-driven event. How important will digital streaming, artificial intelligence, and digital infrastructure be to the tournament's economic impact?
Well, now with the new trend of AI, everything is connected, and the data statistics are easily now being used. So I believe it will be easy for the FIFA organization to assess the huge impact of the World Cup. It can assess as well I can say about sorry, the competitive balance within the matches. So AI is an easy platform, giving a lot of data for the organizers.
Investors are paying closer attention to sports than ever before. Which sectors and industries stand to benefit the most from the 2026 World Cup from your point of view?
Well, we can talk about, as we said, the broadcast, because now with three cities, so we'll need a huge coverage. We'll talk about the hospitality organizations, such as the hotels, such as travel companies, such as transportation. It's a lot of, how can I say, a lot of organizations should be involved in this World Cup.
When the tournament concludes, what key indicators should we look at to determine whether the 2026 World Cup has been an economic success for both FIFA and the host nations?
Well, first of all, FIFA itself, through the statistics, can check the meeting or exceeding revenue targets. We can check as well the strong attendance and ticket sale. We can as well check the tourism and visitor expenditure, like spending level. We can check the hotel occupancy and the business revenues. Last but not least, we can check as well the legacy, how far the infrastructure will be used after the World Cup as well.
From Al Wajh, Saudi Arabia, that was specialist in sports education, Dr. Joelle Daw. Thank you so much for your insights, and I guess that brings us to the end of our economic bulletin for today. Many thanks for watching, and stay tuned to Q News for the latest updates from the worlds of business, finance, and global affairs. And don't forget to follow our coverage during the World Cup, where we will go beyond the action on the pitch to explore the business of the tournaments, from sponsorships and investments to tourism, trade, and economic impact of the world's biggest sporting event. I'm Mona Musarhi. Many thanks for joining us.